Once again, welcome everyone, and thank you so much for your patience. We are starting the webinar on time, and we'll see how the session progresses. I'm sure a lot of you will have a lot of questions. You can use your chat options, which is at the end of the corner, and if you have any questions which you want to ask during the presentation, after the presentation, please go ahead, and we'll try to make it more and more interactive as it's a webinar, so mostly I will be talking and all of you will be listening, but I'll be appreciating really if you have any questions, ask then and there, and I'll try to answer there or by the end of the session. Um, Before I begin, just want to make sure that everybody can see my slides, everybody can see the presentation. Is my audio audible? Is everything okay? Please use your chat options to try this out. If you can hear me properly, if you can see my presentation properly, please send a yes or a okay, and I'll get a signal to start. If you can see my presentation, if you can hear me properly. All right, okay, okay, okay. All right, so I'm getting, okay, most of you have said yes, so I'm just gonna go with that. In case if there is a problem or if you feel that there's a disturbance or anything happens, the recording of this session is going to be put on YouTube, and later on you can definitely view this. The advantage of doing it live is if you have any questions now, or you can directly ask rather than waiting, right? So the outlook for 2023, these are very important sessions because what we kind of discuss now is going to shape up your portfolio or is going to shape up your thinking about how 2023 is going to be. So whatever we are going to discuss, obviously it's not a written recommendation. Please consult your risk managers, consult your portfolio managers before you take any decision, because financial markets are extremely risky. A lot of people lose their capital during the market volatility, and that's why you need to be very, very careful. You must attend sessions like this for information, but before you take a decision, please look at your risk appetite, talk to your financial consultants, talk to us one-on-one, and we'll definitely be able to guide you and allocate your resources for you. Now, to start with understanding what has been going on so far, the agenda for entire 2022 and something which took the entire show this particular year was the Federal Reserve's war on inflation, and followed by Russia-Ukraine war, and we saw uh, stock markets going down. How it all started, because at the outset of the COVID-19 pandemic, the central banks, not just US, but across the world, they slashed their interest rates. So US central bank reduced it to zero because every central bank had just one objective in mind during the pandemic, and that was to prevent an economic catastrophe. And as the pandemic progressed, and rather, I should say, as the pandemic fears reduced, um, the next year, the 2021, we saw a combination. There were supply chain disruptions. There are a lot of businesses who were suffering because there were supply chain disruptions. Goods could not reach from one point to another. And then there was a pent-up consumer demand. Pent-up consumer demand means because entire 2020, there were restrictions and lockdowns. So when the economy reopened, there was a lot of pent-up demand, which where the consumers or the businesses, they demanded to get back in the market real quick. So every raw material, every product was in very much demand, but there was the supply chain disruptions were still there. So you see that less supply and more demand, it could lead to increase in prices, and exactly what happened, because with disruptions in supply chain and consumer demand penting up, the unemployment, which was historically low, and interests were completely low, we saw inflation going higher, because if unemployment is low and cost of borrowing is low, and then there is a lot of demand, so obviously the prices continue to go high, and that's what created an inflation which we have not seen in decades. It's a 40-year high inflation what we saw. And central bank initially, they dismissed any talks about inflation because they thought that this was something which was temporary. And it's really important to understand this, why it increased so much, because central bank, they thought that this was transitionary, it was temporary. But then when the prices continued to go higher and stuck around for longer than expected, then in March this year, central bank started raising interest rates. For those who are new to financial markets, raising interest rates means raising the cost of borrowing so that businesses, they reduce they reduce the credits, they take less loans, and they do not borrow more money, because when they increase the interest rates are increased due to control the money supply. And when I say control the money supply, that means because when inflation is too high, that means the demand is too much, because there's too much cash in the pocket of the people. And when credit rates are increased, when interest rates are increased, the businesses, the individuals, they take less loans, economic activity reduces, and the cash in people's pocket reduces. That's the layman example. And when that happens, the demand automatically comes down and inflation starts coming down. So central bank has a target of 2%, which they have to maintain. And last October, when initially in June, the inflation, the target, which was 2%, it went up to 9.1%. And that's where the central bank started increasing rates over rates, and we have reached to a target of 3.5 or 4% of interest rates. This October, when the CPI data was taken, the inflation reduced from 9% to 7.7, and this showed that Fed's war on this inflation, it has started to produce some victories. But obviously, this came at a very higher cost, because due to higher interest rates, there has been economic slowdown. um, Countries like US are talking about being on a brink of recession, and that is something really important we're going to talk about. And when something like this happens, there's a lot of economic uncertainty, and when that happens, people start selling stocks. Part two, what we have seen, that stock markets have started coming down. Any riskier assets, even cryptocurrencies, if you see, it has started coming down. And now when we are heading to 2023, the question is whether the higher interest rates will cause a recession or not. Another question, which a lot of investors, somebody just wrote it right there, that the most important thing people want to know, that have the stock markets bottomed out yet? And that's really important, because I'm sure everybody has this thing in mind, that for how long stock markets are going to fall. Now, with interest rates likely, they're expected to rise a little more in 2023. Um, Inflation is still at its peak, and everybody wants to know whether the stock market has hit the bottom yet. Uh, what we have to see is the expectation from indexes like S&P, even during the fourth quarter and the beginning of 2023, still expected to be on the downside by another 1 or 2%. And if we see, there were a few factors which came in between that could have given push to stocks, and it did. If you see during the midterm elections, what we saw in the beginning of first week of November, second week of November, around 8th, 9th of November, where the US voters decided that who's who's going to be handling the Congress, whether it's going to be Democrats or Republicans, and we saw the House being in majority by the Republicans. So we saw a slight push in the stocks, and we have seen, if you see the statistics since 1945, S&P, the global benchmark, they have gained around 6% during the midterm elections around the fourth quarter. So that is something which we saw during the mid of November. Now, during 2023, the major expectation from inflation is to reduce. It is expected that inflation might come down a bit, which is the result of the central bank increasing the interest rates. So now the question is, inflation will peak out in 2023. If that happens, then we might see few stocks getting higher. But again, the most important part is, so let's see what happened back there. The entire 2022, we saw the tech stocks mostly falling down, which made the headlines in the fourth quarter. We saw crude oil, Brent. So Another thing which happened in 2022 was the Russia-Ukraine issue, and we saw Brent oil jumping up to $100 during the Ukraine war. We also saw in the China, it continued to create COVID policies, and this harmed the stock markets a lot. Uh, Fed, the central bank of US, the Federal Reserve, they did a very massive, aggressive rate hikes to control the inflation, which pushed stock markets down. Um, High energy crisis in Europe happened due to the war situation. European Central Bank, which is the Europe's central bank, they also have been talking about a very aggressive rate hike, and 2023 for Europe could be that year where European Central Bank will also start increasing rates further in a more aggressive way. And inflation, it's no surprise, it has been 40-year high, so that definitely was one of the most important point for 2022. We have seen the Hong Kong stock markets hit 13-year low, and Chinese stocks have been going through a lot. Before this year, there was the real estate meltdown in China, where we saw a lot of real estate stocks coming down. There was a reform about regulation in the tech companies of China, and we saw Chinese tech stocks also coming down. So that has been also one of the most important points in 2021 and 2022. Now, UK, we have seen a new prime minister has joined in. We have seen in Japan, the Japanese yen, the downturn of the JPY, and then the midterm elections where we saw the House of Representatives now have gone to Republicans, which means now Congress is mixed. Earlier, it was a Democrat. Joe Biden could create the laws, get them passed, and go ahead with it. But now there's a Congress which can oppose. So that has happened throughout. And now to understand the sector's outlook for these stocks. So while we were talking about, as I said, that if the inflation peaks out in 2023, and if central bank uh, continues to increase the interest rates in the first half of 2023, but then by the end of 2023 they stop and end the rate hike, that could bring a bullish pattern for the stocks. When I say bullish, that means a rising pattern, but mostly during the end of 2023. uh, Still expected, because equities at this point of time, the stocks at this point of time, um, with higher interest rates, it's definitely a bad news for stock prices. The higher interest rates, they increase the cost of capital. It discourages the companies from borrowing and expanding, and thus, as I said, it reduces the economic activity. And when we talk about the earnings also of these companies, the earning growth also comes down, because if a company is growing at a rate of say 5%, 10% year on year, a full year of massive aggressive rate hikes can reduce down the earnings growth as well. So this also puts stocks in a very negative picture, but it also creates a very discounted valuation for a company. So all we have to understand is which category of stocks could get benefit more. And I've met a lot of investors, and sometimes a lot of investors feel that when stocks are going down, it's better to be just away from it or not diversify at all. That is something which becomes a mistake, because you it's not a good idea to be completely out of the stocks. I mean, obviously, you can diversify into bond market, you can diversify into commodities and stocks, but within stocks, you can look for different sectors. So, like, there are two segments. One is called growth stocks, and then one is called value stocks. Growth stocks, I'll give you an example, like Amazon, Netflix, Facebook, Google, basically the technology stocks, right, which are in the growing phase. Value stocks are more like Coca-Cola or Vodafone or Johnson and Johnson kind of companies. Pfizer, for example, right, which are less volatile, but they give you a certain amount of dividend, which is like a fixed income for an investor. And when times like this, so this particular year, 2022, it's been already a very tough year for the stock prices. And with the increasing rates, we have seen that growth stocks, they have come down. If you start looking at growth stocks fund, and when I say growth stocks fund, which means any mutual fund which is tracking the performance of growth companies, the tech companies, you will see it's been underperforming if you compare to S&P 500. And this is something which is a very known thing, because since 2000, 2001, if you see, growth stocks mostly have outperformed the value stocks by a wider margin. And which are value stocks? As I said, like companies like Coca-Cola, companies like Johnson Johnson, Pfizer, Vodafone, Verizon, these kind of companies which are already on a developed phase, and they produce dividends and they attract investors that way. But this time we have seen that growth stocks, after a long time, we have seen growth stocks have underperformed and value stocks have outperformed. And even in 2022, we saw a lot of value stocks also coming down, but they have still held up well if we compare it to the growth companies, right? So look at the performance and you will see that value stocks have outperformed growth. So be away from tech is one thing. I'm talking about a very short term perspective. I mean, if you have to make long term positions for another 5 or 6 years, there are a lot of tech areas which are emerging, which we'll also discuss about. But then when we look at the value stocks, that is something which are right now favorite for investors, because you look at the market volatility, look at the geopolitics, look at the economic uncertainty. Probably interest rates will continue to rise or they might come down. All of those situations, when you buy value stocks, these kind of shocks somehow, relatively as compared to growth stocks, it gets absorbed, because there is a fixed dividend which comes across. Volatility is less in value stocks, and those are few things that why investors should particularly opt for value stocks as compared to growth in times like this, and in the coming next year. So that is something which is there. And of course, unless the next year central bank says we are not going to increase the rates at all and inflation is under control, that is the only point where value stocks can underperform. But as of now, what we see is that inflation will slow down in 2023, but the rate hikes, I think, in the middle of the year, probably after the middle of the year, 2023, the rate hikes will be less. So that's the question which we have to see throughout. And there are a lot of stock market sectors. So the slide which you see right now, we are looking at different sectors. They're looking at every stock market have different sectors. So there are healthcare companies, there are energy companies, there are communication services, and there are consumer discretionary. Consumer discretionary is a sector of luxury stocks. So if you're looking at luxury companies, those are called your consumer discretionaries, right? So now when we start looking at how the sectoral outlook is, because that is again one thing uh, which will be checking throughout 2023, and it's really important. So let's look at healthcare, for example. uh, Healthcare, the valuation of the stocks are really good, and these are called defensive sectors, right? Healthcare, utilities, these are called defensive sectors, and defensive sectors are those which are called recession proof. Apparently, basically the value of those stocks, they don't um, fluctuate as much as the growth stocks during recession and during other uncertainties. So healthcare is one of those defensive sector, and the valuations for healthcare companies seem really well. And if we see from even in healthcare, there is a particular category, the companies which are into healthcare equipments. Now, healthcare equipments companies are expected to drive growth in 2023. Pharmaceuticals should provide a cushion for valuation. So pharmaceuticals are there, healthcare equipments are there. Um, Only risk is if dollar becomes more and more stronger, um, that could be a risk for this particular sector. And if we see healthcare for the long term growth, I think within emerging markets, I think that is something which is really important, because if you're looking to invest into healthcare companies, and this is a really important point, guys, I normally keep a notepad with me and I write things down, and I think that is also something which you can do. Within healthcare companies, also, if you're looking, look at the emerging markets. Look at those countries where aging population is high. That's where healthcare performs well. That's where the healthcare, whether it's about vaccines or healthcare equipments, that's where the major revenue comes out. So from a sectoral outlook, 2023 for healthcare could be decent, especially in emerging markets, especially in those countries where the aging population is high, so you can always keep a check about it. Then let's look at energy. Energy includes natural gas, oil, and for energy stocks, 2023 is going to be really challenging because 2022 everything went well for energy stocks because oil prices just shot up ahead of the Russia-Ukraine war, and we saw energy stocks also going down. 2023 is likely to be a little more challenging. Um, we are going to see the volatility. Even if you see now in energy prices, the volatility is too high and it's not very sustainable. We see whether the OPEC countries or non-OPEC countries, the supply is expected to increase. Demand, we are or anyways expecting 2023, the economic growth will be lower as compared to what we have seen in the previous years. And it is expected because obviously we want inflation to be on the downside. Central bank might continue to increase the interest rates. So overall, economic growth will not be as such. There could be a slowdown. We have already spoken about how US analysts in US, they have felt that US is on the brink of recession, could survive or could fall into recession. So the economic slowdown is expected. In that case, if oil supply rises and demand is anyways low, then prices might get impacted, right? So when we see earnings of these companies, it could decline more, right? We are looking at exploration of oil, we are looking at production of oil, and that is something which is really, really important. And we have to keep a very close watch, especially on those companies which are providing oil exploration equipments or those companies which are providing services for oil exploration, right? Because that is something which is one of the most, I think, refining of oil is one thing, and refining activities are still likely to be profitable throughout 2023. Those companies which extract oil, those kind of companies could still be profitable in 2023, right? When you look from a production point of view, that like those companies which are exploring oil or assisting in exploration and production of oil will be the most vulnerable. However, those companies which are into extracting and refining activities could be profitable in through 2023. So that is something which we should check. And now you see that even within one sector, the outlook can be majorly up or down, but within the sector, there are companies which perform different functions, and how one function of companies like production is more vulnerable. And if you see the other set, which is about refining of oil, that particular section is still more profitable. So that's why you have to talk to your financial consultant that which are the set of companies which are into this, which are the set of companies which are into this, right? Followed by look at communication services. Now, again, that is also something which we have been looking so far. I think if the central bank interest rates peak, and once they talk about not doing any rate hikes, because 2022 was the worst for communication services, because we saw there has been ongoing macro slowdown. And the problem with communication services is today, if I have to promote my business, I will use advertising and other areas of communication. But if there is a macro slowdown, then the advertising revenues fall. So communication services, something which is it's really important. Now, again, how this year is going to be, because 2022 has already seen a fall in these stocks. The valuation of these companies are no longer expensive. Earnings are still expected to grow. Media and entertainment, again, there's a lot of growth potential. You look at telecom stocks, they're still cheap. They have a very attractive dividend yield. So let's understand this. 2022, we saw communication services falling down a lot because of lower advertising. There was a macro slowdown and everything. This particular year also, because there is economic slowdown. But again, as I said, when it comes to media and entertainment, the growth potential is really, really high. And that is something which we have to remember. There are a lot of telecom companies. As I said, that this is a defensive stock. This is a defensive sector, which means it gives you attractive dividends. So there are a lot of communication companies which are at a great valuation right now, highly undervalued because a lot of companies have fallen down in 2022 and they're giving very attractive dividends. So that is one area which you can diversify into. Now, followed by consumer discretionary. Consumer discretionary is not a defensive sector. Consumer discretionary is kind of opposite. It's we are talking about high end consumers, right? We are talking about luxury. Now, again, it has performed decent in 2022. Expected to perform in 2023. The point is why something like this happens. When we see the valuations, again, every company has a certain fundamental valuations, and when we see a decline in 2022, because this entire sector belongs to the premium consumers, I'm talking about the luxury goods, the Louis Vuittons and the Michael Kors and Range Rovers, etc. So this sector is still expected to do well in 2023 because it shouts to a high end consumer, and that is something which is still preferred. Valuations are still very attractive for these companies, still very undervalued, and consumption trends are still expected to be on point. I think Chinese economy is one of the most important point in this, because the Chinese economy has started reopening. We are still expecting, by the way, the first half of 2023, the global demand will still be on the lower side. But if we see 2023 completely, due to reopening of the Chinese economy, the zero COVID policy now, there could be a further demand for consumer discretionary, the luxury sector, and this appeals to the higher income class, the premium consumers. So there is one word which is quality. Stick to the quality names in whichever sector you are picking. And I'm telling you about healthcare, I'm talking about energy, communication services, consumer discretionary. Now look at something, consumer staples, industrials, financials, utilities. Again, right, a lot of these are very, very defensive areas. And I'm giving, as I said, that growth over value. Sorry, value over growth. I'm looking at value stocks, and the sectors which I'm giving you also are mostly value. And we are looking at within these sectors, which are the industries, which are the functions which are more preferred. Um, Look at consumer staples, for example. Again, there are a lot of high quality companies. The fluctuations in the prices and their earnings is very less. And that's the most interesting thing for a longer term of time. So if you're an investor who's very risk averse, who don't want to take very high risk, consumer staple is one area. And we have seen, for example, growth concerns are still there, and market consolidation. There will be a lot of sideways fluctuations. You may not expect a very volatile and very high fluctuation from this sector, and that's why those people who are looking from a very risk averse, very low risk point of view can look into these kind of companies, right? Another thing, and please, if you have any questions, you can continue to write. We are going to talk a lot about other outlook as well. And for example, look at industrials here. Industrial sector is also something which is again really important. And industrial outlook, when we talk about industries, look at recession, like the recession fears. There are a lot of risk, and industrials very, very sensitive to the overall economic activity. I'm talking about constructions of bridges and everything, the manufacturing, the industrial production, everything. Now, I think a lot of you already have acknowledged this fact that economic slowdown has happened, and there are a lot of countries which are on the brink of recession, right? And the demand has already slowed down, and that is another reason that industrial production, the entire momentum of the production, is expected to slow significantly. So now that is again, if we're talking about transportation companies, we're talking about those companies which makes machinery for production. They're going to be really affected by a global. I mean, if you see the global growth, and if it slows down and recession risk comes in, all those companies which are transportation segments, capital goods, machineries, definitely it might get affected. But then look at the other part. Again, as I said, the most interesting thing, then when you're looking at one sector, just don't look at the one sector. Look at the functions. Look at companies which are related to aerospace, defense, defense companies, and I'm talking about defense, which means arms, ammunition, private jets, like military jets. All those companies, they might get benefited because this particular 2022, There were escalating conflicts between Russia and Ukraine. It's expected to continue in 2023. Geopolitical tensions expected to continue in 2023. So that particular sector in industrials might still get some momentum. So again, guys, this is one of the most important things which you can remember, because next time when you are learning about a sector, you have to learn about the sector and the functions those particular companies do. While we have within industrials, we have one sector which is very vulnerable, very risky to invest into because of the high recession risk. The industrial production companies, the capital, the machinery manufacturing companies, the transportation companies, and then there is another sector which mostly is connected to arms and ammunitions and defense. And those are expected to still perform because of the rising tensions between Russia and Ukraine if it continues through 2023. And then followed by another sector which is called utilities. And utilities are mostly your electricity and the daily products which you use. And we are looking at two very important things. Now, utilities, first of all, was one of the most resilient sectors 2022. Uh, Again, as I say, it's a defensive sector. So whenever people get scared of what's going on, they would start investing more towards defensive sector rather than technology, right? And that's what we saw in October 2021 throughout 2022 also. Now, I still feel that 2023 is also going to be favoring mostly utilities because growth is expected to slow down. The recession risks are intensifying, and that is the one most important thing why investors would continue to favor utilities, uh, give you a fixed dividend. So that's one thing. Earnings are expected to be resilient. I mean, valuations are a bit expensive, but then the point is the sector can perform in line. And if there is a very severe slowdown, now that's where we have to understand that if recession is too bigger than expected, then probably this sector also might get impacted, because if the recession is too high, if slowdown is too high, then again no sector can perform well because people get scared, they get take money out of the stocks, start investing into bonds or gold or commodities or something else. But then over a reasonable time, 2023, it's expected that utilities might continue to perform well because growth slowdown will still be there, and consumers, investors will look forward to invest into something which gives you a fixed dividend like utilities, right? Moving on, we are looking at three more sectors. I'm talking about, again, IT and equity styles and materials. So when we look at IT, boy, technology as the stocks, technology stocks, entire 2021 October onwards till now 2022, tech has fallen down. We have seen this particular sector in 2022 very high, highly sensitive. So always remember this: whenever there is a high interest rate environment like what we are into right now, technology stocks are very, very sensitive to the rising yields. And there are still talks about that if central bank is done with raising rates in 2023, if inflation gets under control, then tech stocks are already valued well and people start buying technology stocks. But the whole point is, again, as I said, if central bank decides to stop the rate hikes, only then. Until then, if you want to look into tech stocks, we have a particular slide which is only dedicated to see the future trends, and a lot of them are technology related. But I'm talking about another next 4 or 5 years. And if you're looking at those sectors, like within those subsectors, look at software and services. Those are the most stable stocks. They have high share of recurring revenues, and those kind of companies are probably well in IT. Please make sure that you're away from the noise. Even in technology, there are subsectors, and as I said, software and services, where there are companies which have a history of recurring revenues, and they're still better to invest into rather than your noise of Facebooks and Apples and Googles, right? So that's where you have to talk to us. You have to talk to your risk consultants, financial consultants, and ask those companies which are those companies on the basis of valuations and their functions we can invest within tech. Now, followed by materials, if we see equity styles and materials. Now, with materials, again, as I said, there has been a major equity sell off. This particular sector is very, very cyclical, and I'm talking about again, 2023 is going to be a lot more pressure for the material industry. And same thing, we are talking about um, construction based companies, we are talking about metals and mining and chemical based companies. And as I said, all these manufacturing companies, if the global economic slowdown happens, then a lot of these companies are going to get impacted. So you have to be very, very careful, because this particular sector in specific is expected to face the sharpest contraction in 2023. And there will be a lot of companies which might have to cut back on their plans and operations, and they might even reduce dividends. So if you are looking for a dividend income based company, uh, what I feel is slightly be away from materials, because a lot of these companies, they're expected to cut back on their expenditures during this particular year, and they might cut back on the dividends also. So please try to be more connected towards companies which are related to probably utilities or financials or industrials, but again, very specific sectors, very specific quality companies I'm talking about, right? Please continue to write. I see a lot of questions coming in, and I'll try to answer them post session. While please, if you have any questions, please continue to ask, and I'll be more than happy to reply this. Again, equity styles, 2022, very challenging year. We're looking at the very negative market. It started with high interest rates, geopolitical events. We saw, again, defensive sectors, they were still better, did come down, but still better. 2023 looking very, very challenging. Lot of uncertainties. But again, as I said, just continue to be more closer to the dividend yielding stocks. And I think that should be a major idea within technology. Be connected to software and services sort of companies, which gives you more earning stability and high recurring revenues. And that is something which is really, really important. It will be really, really, I feel, as an investor, it will be very wise if you go for minimum volatility, right? And prefer dividends. That is something which is going to protect you if there is an outright recession. So this is what we are thinking about different sectors and different equities. Now, I can also provide you a regional outlook, because what I just told you is more of a sectoral outlook, right, within the companies. I mean, we're going to talk about regions, and that's really important, because our investments are US, UK, Eurozone, right, Swiss, Japan, Asia. Then we have Latin America, we have Middle East, Eastern Europe. So a lot of these regional outlook is also really important for you to understand that how it is expected to move, because if we are looking at all the way, let's say from US, for example. Now, earnings, because a lot of these companies have fallen down in 2022, a lot of sectors, so valuations have become cheaper. And we see the earnings picture of that, how the earnings are going to be. Because in 2022, central banks, they increased the rates. And now, if we look at the technology sector, which US is very exposed to, right? Think about, okay, this is one thing which you can do on your own right now. There's one question. US market index more easy to trade. US market index more easy to trade. Okay, except individual stocks. So one thing is, you can trade both actually, stocks and indices. So there's a question that US market indices, more of a statement that US market indices are more easy to trade than the individual stocks. If you're talking about trade as in buying and selling, then yes, stocks, they won't move much every day, but index, if it's Dow Jones, will move 300, 400 points. If it is NASDAQ, 150, 200 points. So yes, index becomes easier to trade. With stocks, if you another thing is, if you invest into individual stocks, it kind of exposes you to a very specific security risk, right? That if you, instead of buying S&P 500, if you have just bought one company, say Walt Disney, for example, so tomorrow if pandemic kicks in, Walt Disney is down, right? But if you had invested in a stock market index, then your risk is exposed into those 500 companies. So definitely less riskier than an individual stock. The only thing is the choice of that index, because if you pick something like Dow Jones, which uh, tracks the performance of 30 major US companies, and these are the companies I'm talking about, like Citibank, JP Morgan, Morgan Stanley, your Microsoft, etc. If you only invest into Dow Jones, then your risk is slightly higher, because these are blue chips, but the index moves a lot and it reacts to the entire global situations, right? However, if you invest into something like S&P 500, your risk is exposed to 500 companies, and the value is less as compared to Dow Jones. So yeah, the choice of market index is also really important, right? Coming back to what we are understanding about US over here in the regional outlook. So tech stocks suffered a lot. And if you see the top 10 companies in US by market cap, yeah, sorry, that's what I was talking about. If you're here, just Google it out. I'm sure some of you will know the answer. Some of you can Google it. Top 10 companies by market capitalization in US, or just write top 10 largest companies of US and tell me what you see. Give me the first three companies. Top 10 companies by market capitalization. Look for it and give me the top three or top four companies. You can use your chat options to write it. Okay. Okay. Right. Okay. Perfect. 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 We'll take just one more minute. I see a lot of people participating here. Top three, four companies of US by market cap. Okay. Perfect. A lot of you have got similar answers. There is Apple, there is Google, there is Microsoft, there is. So what I'm trying to tell you is that US has been exposed to technology longest, right? If we see a very particular exposure to the technology sector, and that particular sector has been under strongest pressure in 2022. Now, there are a lot of those sectors in US where people can invest into, right? But the point is, if you compare US markets to the rest of the world, the valuation is still very much at premium. Growth is expected to slow down. Economic outlook still better than Europe, right? Because right now Europe is going through a major war crisis between Russia and Ukraine, very much dependent on the energy imports, but US is less dependent on energy imports, right? So in 2023 could be a year of two very different halves of US equities. So as long as the central bank, Federal Reserve, as long as they keep it very restrictive stand, uh, central bank continue to tighten up, equities will show a very muted performance. If central bank continues to increase the rates, keep a higher aggressive policy, we'll see equities not really performing that much, very muted performance. Once markets understand that this is where the inflation has peaked and now the central banks are not going to be very aggressive, that's where the US stocks have that scope to recover. So I guess 2023, this particular, it's going to be into two halves. It's better than Europe because Europe is much more dependent on energy imports from Russia. So US is at a much better position. But again, within US, if the tightening does not loosens from central bank, then we might see the stock performance muted. But if it does, then market prices it, then we might see a very favorable stock market in US. So this is where we look at the US outlook at the moment. And then if you see UK, again, valuations are well, really good for UK. And if you see, UK stocks have outperformed a lot of global stocks in 2022. Earnings were stronger. a lot of stocks within UK which belong to energy sector and defensive companies. They performed really well. And if you see in 2022, pound as a currency has also depreciated a lot. So that again, the UK stocks got benefited of a depreciating currency. The revenue, if you see in international markets, gone up. So UK still uh, very meaningful, very attractive valuation. Uh, there are, and please remember this: UK has companies which have one of the highest dividend yields. So there are a lot of such companies in UK which gives you a very very good dividend, right? The only thing is a lot of such companies they're coming up with a very negative earning growth forecast for the next 2 years. So as of now, there is no catalyst for valuation in UK uh, unless there because there is a pending trade deal with European Union, right? There are geopolitical uncertainties. So I would still see UK very very carefully. Yes, there are some companies which have really good dividends. Just pick those specific companies which have a decent earning growth forecast also and gives you a good dividend, because pound has been depreciating a lot and we have seen UK market getting UK stocks performing well in entire 2022. So pick out those companies which have good dividend yields and have a stronger earning forecast. Again, quality names, because unless the trade deal with European Union gets finalized and geopolitical uncertainties they become better, only then UK market will be much more favorable option to invest into. Uh, Next, I think if you look at, I think it's a no-brainer. We are looking at Eurozone, and Eurozone is in a very, very cautious position because Eurozone faces the geopolitical risk, the growth risk. Their outlook is very clouded. I think you have to be very cautious before you invest into any Eurozone equities, because the regional markets within are going to remain under pressure. And that is something which is really, really important because Eurozone, um, I think it is already in recession, and going to 2023, the geopolitical risks further are really going to complicate the outlook for this region. So, if you see, even the earnings of a lot of companies in Eurozone are expected to decline. There is going to be a sharp deterioration, which is expected in consumers and businesses. If there is any potential peace agreement regarding Ukraine, that could be a really, really positive development for this region. But until then, I would suggest that there's a lot of gloomy outlook from Eurozone. So just slightly be away from that part. Again, as I said, that US and UK are more preferred than the Eurozone. When you say shorting Eurozone index, yeah, I think uh, will not be a much bad idea. Definitely not. I'm as an individual investor, I would definitely refrain from buying any European stocks at the moment, because the year is going to decide. European Central Bank itself is going to do very aggressive rate hikes because Europe is also under inflation, and then followed by geopolitical uncertainties. I think it's really risky to be on the buying side. So yeah, talking to your financial consultants, as I said, if they recommend you a short, if you have your risk appetite, then looking at that situation, you should take a call. But this is what the outlook says at the moment. And I think we should definitely look more and do more research into it. Then there are economies like Swiss, for example, defensive characteristics, looks attractive in the middle of all this uncertainty, right? So I think even Swiss has a lot of healthcare companies, consumer staples, and the good part is healthcare and consumer staples, and these are defensive sectors. They create 60% of that index. So I think that is something which is really important, because during this volatile environment, growth is slowing down. I think Swiss equities can still outperform. The earning outlook for a lot of Swiss stocks is still very much bright. They're expecting a double-digit earnings growth in 2023. Swiss franc, the currency, has become also very strong. That is the risk for the export-oriented companies in the Swiss market, and Swiss is a very export-oriented market, right? So the whole point is looks very strong. The index of Switzerland, the Swiss index, 60% of that is made from consumer staples, and defensive sectors, which means low volatility. The only challenge is a very strong CHF, which, I mean, historically in the past, what we have seen is the Swiss market particularly adapts itself to a stronger Swiss franc when it happens. But since it's an export-oriented country, a strong Swiss franc could impact. But again, as I said, that as the year progresses, you will see. But again, one of the finer options to look at, as it provides less volatility, and the stocks in Switzerland are expected to show you a double-digit earnings growth in the coming years. So I think look at that area also while you are talking to your risk consultants, right? Yes, low volatility index, exactly. Then we are looking at for Japan, Asia. Actually, Japan, Asia should include China and India and others. But then we are looking at Latin America. We're looking at Eastern Europe, and again, just to discuss a bit about Japan, equities outperform the equity markets. Again, currency continued to go down, so that is something which is important. Most central banks, they have tightened aggressively, where global central banks throughout the world continue to raise rates. Bank of Japan still continues to be very, very loose in their central bank policy. And that's why we have seen Japanese yen getting weaker and weaker. And that has been a dominant factor for Japanese equities in 2022. It's going to be a very dominating factor for Japanese equities in 2023. So the valuations are still cheap for Japanese equities. It's a very cyclical market, might get impacted from economic slowdown. So why I'm telling you this, that when you see throughout the year, you have to see that the economy performed well because currency was weak. Again, as I said, that if you see from a growth perspective, Japanese equities are cheaper at the moment. But again, economy is a very cyclical market, which means when the slowdown comes, it might succumb to it. It might get impacted. So be very careful. Again, stick to the quality names, pick out your quality names, and then look into it. Right, but it's not a Europe at the end of the day. Again, so and then followed by, if we see Asia, and again, Asia is also most important component when we talk about investments. And sorry, one second. Yeah. And if we see Asian equities, and now I gave you outlook separate for Japan, and I'm telling you separate for Asia. This excludes Japan when I'm telling you. Most of the Asian equities have been really under pressure in 2022 because of China's zero COVID policy. Now that slowed down the global growth. Dollar became more and more stronger. So the companies within China, the regional earnings also slowed down. Again, 2023 for specifically for China is going to be very, very challenging year. And the central banks are expected to keep tightened monetary conditions. Asian economies, a lot of them are going to be impacted. Again, guys, there are separate areas also. Like for example, Chinese economy expected to remain weaker, in spite they continue to reduce down interest rates and inject more and more cash in the economy. Um, if you're looking this particular year, they have loosened up their stringent COVID policy, right? So South Asian markets should get benefit from this post-COVID recovery. Um, Regional equities, they will perform, but within Asia, I think continue to prefer stocks which are linked to the China sustainability drive, because those are the companies, like the government companies, which get a lot of government support, right? Those are the companies which still deliver good earnings. So that is something which we have to keep a check. For China, understand this, that last year they were very strong on their COVID policies, and we have seen that this particular year slowdown is still going to be there. First half will be weaker, but since they are now getting out of their strict COVID policies, probably it could bring a positivity. But again, that could be in the second half of the year. First half still expected to be on the weaker side. Then we have Latin America. We have quickly we take Europe, and Eastern Europe, Middle East, and Africa. Um, Again, if we see throughout, most important part over here is the geopolitical shocks. Energy prices, again, another really important point in Eastern Europe and in the Middle East. So that is something like, if you see Eastern European market, for example, they have suffered a lot from the Ukraine war, right? And that could continue in 2023 also. South Africa, in fact, if you see the African part, South Africa is expected to deliver returns in line with the benchmark, but the earnings outlook is again weak. If you see metal prices, and Africa is a very South Africa is a very commodity oriented economy, so metal prices have come down, and that's why we have seen earning outlook has also been lower. Global growth has also been affected. Middle East GCC markets, again, very impressive. Middle Eastern markets have been, and continue at this moment. Middle Eastern GCC markets, they're on the track to generate the strongest returns of any region globally, and this is for the second consecutive years, right? And that is, I'm telling the reason behind this. First of all, elevated oil prices. Oil prices went up. That was one of the most important things, right? And this has created a current account surplus of excess of $1 trillion, and this is going to be over the next 3 years, right? So that is something again which has happened. And then there has been a lot of IPOs which have come across. So earlier we saw a lot of Middle Eastern nations, they were very away from foreign investments, but now there have been a series of IPOs. They're allowing foreign ownership limits, and that have actually helped increase the GCC's weightage in the overall benchmark. So I think these are a few factors which are really, really good for the GCC market, and they have shown phenomenal growth. They're on the verge of showing phenomenal growth, and this is something which you have to check. That's why emerging market investors, they have to be always been into into consideration when it comes to investments, right? So from a regional outlook, again, you can see these few nations, and as I said, that we are giving you a very elaborative outlook of what is expected. But again, our very limited time, and I'll be more than happy to have a one-on-one discussion with all of you. Anybody who wants to have a discussion about outlook and where to invest, we have very capable risk managers and financial consultants who can help you out and help you design a portfolio as per your risk objectives. Another thing, which now we are moving from equities and sectors, we are moving from economy outlook. So I gave you a sectoral outlook of equities. I gave you a regional outlook of the economies, and then now let's move on to an asset class which has been talked a lot about, and we're talking about bonds uh, and fixed income products, which got a lot of momentum here because bonds have kind of made a comeback. And in 2023, even if interest rates are set to decline, there are a lot of attractive bonds, and we are going to share a bond list also with you by the end of this session, which we have made, and you can look into this. There are a lot of investors. Still, you have to keep a very close eye. Stick with quality US high yielding bonds, right? Corporate bonds, government bonds, but quality names. Investment grades, normally what we talk about. And I would suggest a shorter term maturity, 3 to 5 years, basically. I think that's really important. And again, as I said, bonds, when we talk about, these are fixed income instruments. If anyone who has not invested in bond before, we can see and we can understand that bonds are something which gives you a fixed coupon. It kind of protects your capital. I mean, you can, if you buy a US government bond, then more or less you expect that you will be repaid your capital after a certain amount of time, and along that you will be given a coupon also, which is more or less like how bank treats you. So once you borrow money from a bank, right? When you borrow money from a bank, what you see, when you borrow money from a bank, they charge you an interest, and then you have to repay them a cash, right? Similarly, when you buy a bond from a government, basically you are giving a loan to the government, which they will repay you after a certain period of time, along with a rate of interest, which they call it coupon. So there are a lot of fixed income investments, and a lot of bonds have been performing well. We have seen bond yields increasing, and we have seen a lot of bond based investments which people have started. looking into, and that's really, really important because bond investments at this point of time could be even a better idea than INR or a rupee fixed deposit. I'm going to share a flyer with you which will tell you that at this point there are a lot of treasury bonds which are giving you a better yield. And since Indian central bank is expected to increase the interest rates, it is better to be rather buying US bonds in dollars rather than putting your fixed deposits in INR. So that is also something which a lot of investors have been talking about. Bond yields have meaningfully increased, and this has provided a lot of investors an opportunity to earn decent income because inflation is going to be around, like, say, even if it is 4% or 5% by the end of 2023, right? Look at the 10-year bond, for example, right? They're still yielding more than that. So understand the point is, as of now, inflation adjusted or a real yield could turn really, really positive. There are municipal bonds, there are corporate bonds, which are even providing more coupon than the US Treasury yields, right? Because the risk in a corporate bond is higher than a government bond. So if you buy a corporate bond, you will still get a better yield as compared to a government bond, but obviously the risk also increases, right? So there are a lot of bonds which at this point they're fairly priced. uh, they can really offer you a very attractive capital gains because at this point of time we have seen a lot of bonds trading at discount. Also, yields are expected to go higher, and let's see this in a bigger picture. If you look at stocks versus bonds and large companies also, you will still find stocks more expensive, right? And look at the risk part, the reward for owning stocks over a risk free. And when I say risk free, I'm talking about government bonds. I mean, we call it risk free if you, if it's a good, strong government, right? Not if it's a Venezuelan government. But if you borrow money from US government, you're more likely to get it back. So that's why we are using this term. But let's say, and there are risk-free bonds which are called treasury bills that are for 1 month, issued monthly, up to 1 year, and those are the bonds which kind of provide you a risk-free premium also. So if we look between equities, between stocks and bonds, I think a higher weightage towards bonds will make a lot of sense. So prepare yourself for that. I think that could be a very good portfolio where there's a high exposure toward bonds, quality names, again, quality investment grades giving you good yields, and a substantial part towards stocks also, but the stocks, the sectors which I just talked about, right, within those functions. Now let's look at the opportunity part. So 2023 could be an opportunity to position the portfolio for the longer term. Now we are talking about a longer term. Now, what is the longer term when we talk about? Because longer term is important, right? A lot of you must be thinking about, okay, what if I want to hold the trade for another 4 or 5 years, right? That is something which is important. I'm sure a lot of you must have thought about that if I want to take a long term position. Now, equity market turnaround, if we see in the short term, I think you're approaching the point when bad news for the economy could become good news for the stocks, because what will happen over a period of time, if economic growth slows down, it will control inflation also. If inflation get control, then the central bank will stop increasing the rate. Eventually, by the end of 2023, we might see the stocks getting bottomed out. So if you're expecting to make a long-term position, again, 2023 could be an opportunity. Observe this year and see what happens to the inflation. So inflation and central bank rates are the two important key ingredients of your observation when you'll be making a portfolio. Another thing is earning adjustments, because there are a lot of corporate earning expectations. They're still coming down because if you see, there is earning expectation and there is actual earnings. So a lot of companies are reducing their earning expectations, which means that's what happened in pandemic. A lot of companies, they just lowered the expectation. So whatever number used to come higher the expectation, stocks used to move higher because the company performed better than expectation. So that is what is expected. There will be a lot of earning adjustments this particular year. And then again, when you see volatility, there is always a potential opportunity, but then you have to consider your risk, and that is something which is really really important, because there are still a lot of sectors which we are going to talk about, and you have to keep a watch on key signals, keep a watch on US labor market, keep a watch on central bank rates, uh, look how Europe copes up with the energy crisis, look what China is doing at the moment and how China progresses. So I think these three, four things are still, it will provide us a good opportunity to position our portfolios for from a very longer term perspective. Now, before we move on to the emerging trends which are going to be continuing in 2023, let's look at the commodities also. We haven't discussed commodities yet, and I think a lot of your questions were directed here that what about the commodities? So for them, I'm going to answer this question about the commodities. Uh, Commodity prices are, so if you see what's been going on, most of the commodity prices have retreated from their peaks, and that has happened post pandemic. I mean, um, the Russian Ukraine war happened, post pandemic happened. After that, we have seen commodity prices. Now they have come back from their tops, and this decline has been mostly because of the global growth slowdown also. So that is also something which is really important. So if you see in the chart, all these energy, agriculture, metals, all of them have started coming down. Individual commodities have still seen diverging trends because of the supply conditions, right? Again, demand is something which is really important. But if you see commodity prices here, commodity prices still expected to remain elevated when you see in domestic currency terms, because there has been a lot of currency depreciation. See it this way, from February to September, the price of Brent in US dollars fell down by, I think, around 6%. But because of the currency depreciations, almost 60% of oil importing emerging market and developing economies saw an increase in domestic currency oil prices, right? See India, for example. So the point is that in domestic currency terms of commodity prices still remain very much elevated. Almost 90% of these economies also saw a very large increase in wheat prices in local currency because US dollar became stronger. So that's where we have to see the commodities in domestic currency and in what happens. Look at oil and wheat prices changes. This is a chart which shows you very clearly oil prices and wheat prices changes in local currencies, right? And this is between February and September, like over a period of 5 to 6 months, what we saw. Right. Next, look at the Brent oil prices. So again, oil prices also something which is really important. If you see the Brent prices fell, and if you see that fall kind of reflects a lot of concern about an impending global recession, right? And China also had continued restrictions because of the pandemic. So all of that contributed to the oil price decline in 2023. I feel around $92 per barrel. Oil will still continue to remain on the same side. The major downside risk is if a global economic recession comes in, then the demand could get weaker, and if production increases, that is going to impact oil prices a lot more. So that is something which you have to keep definitely a check on. Now look at the natural gas prices. We have seen natural gas prices. Now European natural gas reached all-time high and been very, very aggressive. If you see several European countries now, they are going to import, rebuild inventories uh, because again there's been a war between Russia and Ukraine, and Europe has kind of contributed in the middle, and that's where we have seen the gas prices have been continuing to go. Now, if you see prices in Japan and US, there have been a large increase also. So natural gas prices in 2023 could come down a bit because demand is expected to be weaker. But again, this particular outlook depend how severe the winters in Europe are going to be. Because if the winters are much more colder than expected, then it can be a disaster for Europe, and natural gas prices might go really high. again, war situation. We really have to understand what happens between Russia and Ukraine, and that is also going to impact. Then we have seen in case of precious metals. So we talked about commodities in terms of energy. We are talking about precious metals. We are talking about especially how the weak demand in China have weighed on precious metals also, because metal prices fell around 20% in the third quarter, more than 30% lower in September if you compare with the March peak. And the decline, it primarily reflects how the economic activity has been going down, and the demand for metals have also gone down. So if you see the global industrial commodity demand, it has weakened out down, and it is expected to be on the weaker side. China is one of the world's largest metal consumer. So middle, if you see at this point of time, there's a lot of real estate stress going on in China. COVID-19 restrictions have got eased up now, but the entire 2022, we saw a lot of pressure from China, very less demand by China, very weak demand by China, and that has weighed on the metal prices as well. So now, if you see the outlook for precious metals over here, uh, might retreat despite rising inflation and geopolitical tension. So what we see over here is most of the precious metal prices, they have fallen since March, and the reason have been very weak investment demand, also very weak physical demand also, because dollar has gone more stronger, interest rates have gone high. So these factors have actually outweighed. So gold used to be mostly a safe haven, right? If there's a war situation between Russia and Ukraine, people will go and buy gold. But because of this extra high interest rates, high inflation, we have seen that gold prices have still continued to come down, and that is something in 2023 we might see prices continue to fall down if central bank continues to tighten up the policy, right? Now, before we end the session, we talk about opportunities as we head into 2023. And as I said, that a lot of these emerging trends, we are talking about technology based, but again, these are opportunities which are very emerging. So we are looking at cloud computing, AI, Internet of Things, cybersecurity, semiconductors. And if you look at all of that, it's really important. Why? Because if you see uh, a lot of so adoption of cloud computing, AI, automation, this continues and it saves a lot of cost in the companies, helps make better decisions. So I think these are the trends which are never ending. It's going to continue for the 2023 also. If you see semiconductors, for example, demand may continue to prove resilient. We have seen a lot of semiconductor stocks coming down. So that is something, because they are trading near worst case scenarios, right? And investors have already priced the inventory correction and the lower supplies. So semiconductor stocks also you need to look at for 2023. Look for longer duration yields. Again, as I said, what we have to see is from let's see software stocks, software and service. As I said, one of the most important things, look at the quality growth companies. Do not get fascinated by hearing names like, for example, Tesla's, and there are a lot of fancy names which moves around, but you have to see, even if Tesla performs well, if it becomes a quality stock, then why not? But until then, you have to continue with software and service. These two are very important sectors and will continue to emerge in 2023. Comes the most important part, what are the risks, right? Because risk is something which we have to understand. Real interest rates could rise further. Now, that could be a negative impact on the valuation, right? That's something which is really important. If central bank continues to increase the interest rates, consumer spending, as I said, uh, if it continues to get weaker, we have seen a lot of Apple already reduced the production of iPhone 14 due to weaker demand. So consumer spending has also suffered. So weakness in consumer spending along 2023 might also impact. Then e-commerce sector got a lot of boost during COVID, but now COVID is over, right? So we might see again e-commerce sector might underperform a bit as compared to the pre-pandemic and post-pandemic. Then there is Ukraine war. There is a possible US-China war, which is also, I mean, Joe Biden went to China and talked about it, but then the uncertainty still lies, and that is something which is really important. Followed by the regulatory concerns. If regulations become too much stronger for tech or other companies, again, that those are the risks of the stock markets which we have to face. So in conclusion, what we see is fixed income asset classes are more attractive. So try to have more exposure. Again, talk to your risk experts first, only then take a decision. The fixed income looks more attractive. Bond yields reset at higher levels. Inflation is at peak. And if central banks stop rate hikes, we still see continue with US government bonds and investment grades, corporate bonds look very, very interesting at the moment. Um, Equity markets continue to remain really, really volatile. I talked very deeply about a lot of sectors which are available. So look at those sectors, and I think that is something which we should check, because contraction of the valuation is well advanced, but then when we look at the corporate profitability, it remains challenged. What happens in 2023 if the demand is too weak, if there is a macroeconomic backdrop, you might see a lot of volatility. So continue to stick with defensive sectors, right? Again, there are always some super trends like climate change and etc. That is something which have very stable earnings and low leverage. So that is something which is really, really important. Dollar is expected to stay strong, and then precious metals continue to remain volatile depending on central bank decisions. So I think that is something really important. Quickly, I'll just show you the list of few bonds if you would like to see this. Just 1 second. Very quickly before we end this. There's the tab, and here. So these are the bonds with the 3 to 5 year maturities. As you can see, these are the ISIN numbers, and you can check with your relationship managers who have enrolled you for the webinar, and they will be able to give you these lists. And you can look at these yield to maturity around 4.5% on an average. And all of these are AAA bond ratings. Liquidity score is pretty solid. And all of these are United States treasuries, currencies, dollars, maturity in 25, 26, 27, 3 to 5 year maturities, as I said, will be a better idea. Look at the short dated bonds. I think that could be a better way. Right. Followed by, I think this is one more thing, investment grade bonds superior to FCNR. And if you see this, these are some corporate bonds, HSBC, Barclays, NatWest, and Bank of New Zealand. And most of them are triple B, A minus. All of these bonds coupons are around $7.50, $5.50. If you see yield to worst ratio also is around 6.5% yield, right? So these are some corporate bonds. As I said, that corporate bonds have a higher yield than government bonds because of the higher risk. So all of these also you can see. Right. So for more understanding, again, guys, will definitely be available for more understanding and a detailed conversation on this. This was a very important topic because 2023 outlook will always be a big question for everyone, that how markets are going to perform. But in the middle of all that, what you have to remember is always take risk which is not impacting your lifestyle or your future goals, because there are a lot of investors who take very high leverage in desperate times and become greedy to make money. Be away from leverage. Do not take high leverage. That is something which you have to be really, really away from 2023, because high leverage in the area where things are already very volatile, it might lead to capital losses. So if you are a day trader, please keep stop losses, take minimum leverage, or don't take any leverage unless you consult with your risk experts or you understand what you're doing. And as long as if you're a long-term investor, try to make a mix of the portfolio, be exposed to a quality investment grade, short-term maturity bonds, also have a mix of equities, but defensive sectors, quality names, and that is something which is really important you can look into, right? Thank you so much once again. I will be available for a one-on-one session, and you can talk to your relationship managers if you want to come down to the office and have a discussion about this. Once again, thank you so much for coming this session, and we'll be recording. We'll be putting the recording of the session on YouTube. You can later on check, And if you want any more information on what we just discussed, please reach out to your relationship managers. We are more than happy, and you're most welcome in our office at Emaar Square and DIFC. So my name is Yogesh. You have a good night. Thank you so much. And we'll see you next week with a different topic.